Hello and welcome to Options in Plain English Advanced Edition. Today we're going to talk about the Delta-Gamma Approximation formula. This is a formula that a lot of traders use to try to figure out and to calculate what the profits from or losses from a certain position will be. It uses a lot of the Greeks that you may be familiar with. So we're going to have a refresher right now, just to make sure we're all on the same page. On the screen you have the main Greeks that options have. So as you know, those are indicators or derivatives that can give you some indication of how they're going to be moving when certain parameters moving. In this case, we have, for example, we're going to just go through them quickly just so we understand what we're talking about. The indicator, the Greek that tells you how an option price will change when the underlying price changes is called delta. It's used a lot. It also tells you the number of shares that you would need in order to hedge or to simulate that position. Vega measures the change in option price when implied volatility changes. So for example, if an option has 1 Vega, that means that if the implied volatility goes higher by 1%, it'll make $1 in profit from that move. Theta measures the change in option price as time passes. Time passes 1 day at a time, obviously. And this is always something that is going to decrease the value of options that someone is holding. So basically any long position is going to have negative theta. So time decay is going to be affecting them. And one thing that's important to know is that theta is not the same at the beginning of a certain holding period and at the end. So it depends on the time to expiration. Then we have the second order Greeks. So basically, now that we know what delta is, what vega is, and what theta is, now those can change as well. They're dynamic. So when delta changes, when the underlying price changes. So not only are you going to be making money or losing money based on delta, but delta itself is going to change. And this is a very important one. That's why we're looking at it. It's called gamma. And gamma, what it is it measures how delta changes when the underlying price changes. So delta is how much money you're going to make or lose based on the an underlying price move, and gamma is going to measure the how much delta changes when the underlying price moves. Then we have the rest of them. Vanna measures how delta changes when implied volatility changes. Charm measures how delta changes when time to expiration changes. This is also called delta bleed. And then the rest of them, you have them over here: Vanna, Vama, Veda, Charm, Veda, Speed, Zoma, and Color. So basically these higher order Greeks, they seldom have any significant effect on profits. Unless your positions are really, really big, the main factors that affect your profit and loss are the first order Greeks, so how the option price changes directly, so delta, vega, and theta, and also how delta itself changes, so gamma would be the other one that's important. And this is because gamma measures the acceleration in profits when you are long options. So not only, for example, so if you have a position that gives you 50 deltas and you're holding options, then not only are you going to be making money when price goes your way, but you're going to be making more and more money as the underlying price moves. So that's why it's called an acceleration factor. Now let's take a look at this Delta-Gamma Approximation formula. So basically, what we're trying to figure out is if we have a price of a certain position that we're holding, and this position could be made up of any combination of short options, long options, short stock, long stock, short calls, puts, etc., or any combination of them. How we have a price, something changes in those parameters, and how we're going to have a new price, and based on that, whether we have a profit or we have a loss. So we're going to start by just what we talked about in terms of the Greeks and which ones are the most important ones and the ones we're going to focus on. So in order to kind of just like have a refresher in terms of how these Greeks work, let's take a look at a long call. In this case, we have the underlying price here, and we're buying a call, and this call has a strike price K. So when we initiate this position, we have the underlying price here, the long call here with a certain price at a certain strike price. And also when we started, we have a certain time to expiration and also a certain implied volatility. Okay, so when we start analyzing this, we know that if the underlying, in this case of a long call, if the underlying price starts going higher and it starts getting closer to being at the money, in this case, the delta is going to give you some profits because you're long deltas, but also that delta is going to change. The delta that we had initially, for example, here, let's say we have this call has a 30 delta, which is when we initiated the position. As price starts moving closer and closer, we know that if it gets at the money, if the price reaches the strike price, then we're going to have a delta of approximately 50. So we start at 30, and now this call has a delta of 50. So it is very important that we take this into account, because the profits that are created, or losses, but in this case profits because price is going away, the profits that are created or that are the result of this change are going to be based on an initial delta and the delta at the end. So we know that we need to consider both of them because the profits are going to be accelerating in this case. It's not a constant, and this is what gives options their what's called their optionality. So in this case, we have that with delta. We also need to measure how much time passed between the beginning of this analysis and the end, so that we know the impact of theta, and also how much the implied volatility changed. So once we have those factors, we're going to be able to figure out how much, or try to anticipate how much profit we're gonna have when we have a move that we know change some of our parameters. So for example, in this case, we're going to focus on delta, vega, theta, and also we're going to look at gamma, because if the price is sufficiently large, the change of prices is going to affect the delta itself. So we need to make sure that we have a delta that represents the average where this move happened. So let's start analyzing and trying to come up with a formula. Okay, we're going to have our Greeks here, just so we don't lose sight of the fact that these are the ones we're going to be looking at. We're going to be looking at these three, the first order Greeks plus gamma, which is the only second order one that we're going to look at. All of these Greeks are not less important, but their impact is less pronounced than the ones that we are going to be looking at right now. So if we want to come up with a formula that tells us what our new price is going to be, so that we can know whether we have profits or not, we'll start with the fact that something that's very simple to understand. The new price of the position that we have is going to be equal to the old price plus the effect of delta plus the effect of vega plus the effect of theta. And this effect is going to have to take into account the fact that the delta at the beginning of the change or at the beginning of the period that we're analyzing is going to be different than the one at the end of the period that we're analyzing. So now we start looking at the new price, and we try to figure out what the new price is going to be so that we can figure out whether we're going to have profits or losses or and the magnitude of them. So if we start looking at the new price being the old price plus the effect of delta, vega, and theta, the delta one, we are going to multiply the delta by the price change, of course, because delta measures the change in option price when the underlying price changes. And of course, all of these, we have to take the actual sign into account. So whether it's a negative change or a positive change. So this is not so straightforward because delta itself changes as well. So if we say that something changed by $10, then the delta at the beginning is going to be different than the one at the end. So we have to take into account this change in delta itself. So what we try to do, and it's probably not mathematically accurate, but it's accurate enough for us to figure out quickly whether what our profits are going to be or what our losses are going to be, is we just average out the both of these deltas. So the delta at the beginning and the delta at the end. The delta at the end is going to be the initial delta, so the delta on the day prior, let's say, plus the change in delta. The change in delta is measured by gamma. So we multiply gamma by the price change. The same price change that we're analyzing here, the same one. So now we know it started at 30 delta, for example, and it ended up at 50 delta. So we're going to do the calculation as if it was 30 plus 50, 80 divided by 2, 40. So we're going to assume that the change in price took place all the way from here to here. So basically for, let's say, $10, if the change was $10, and instead of using only the delta at the beginning or only the delta at the end, we average out the two, and now we know we have a pretty good approximation as to what the effect is going to be on our option price, and therefore what our profits are going to be. So delta plus the change in delta divided by 2, so we get an average, and that we multiplied by the price change, and we have the effect of delta on the new price. Now, the effect of vega, we have to take into account the change in implied volatility measured in percentage points. So if the IV changed from 40 to 41%, it would count as 1. So not the 2.5% that it represents, but the actual percentage points counted like that. So from 40 to 41%, it would be 1%. So if the vega was 7, for example, then a positive 7, then 7 times 1, we're going to be making $7 based on vega alone. Theta, for long options, calls and puts, is going to be negative because the option starts losing value as every day passes. So theta measures how much you're going to make or lose based on one day. So if we're measuring 1 day, this is easy. The time elapsed is 1. If the theta is -2, then you're going to be losing $2 every day that you hold that position. Now, if we develop the formula, we come up with the actual formula that traders use, which is that the price of the option is going to be the old price that we had before, plus the delta times the price change. So it's the effect of delta. And then the effect of gamma now, we're just developing this formula into this. We multiply price change by price change. We have price change squared. And then take out the 1/2. And delta plus delta, 2 deltas divided by 2 is 1. That's why it's delta times the price change. And then 1/2 of gamma multiplied by the price change squared. And then vega times the change in implied volatility and the time that has passed multiplied by theta. Now we're going to use the formula in an actual example on the platform. So now we're on a trading platform and we're going to be using our Delta-Gamma approximation to try to anticipate or try to approximate the profits or losses that we're going to get based on some changes in the market. For this example, I'm going to be using the ETF for gold, GLD. And what I'm going to do is I'm going to use gold. It's trading at just around $161. And I'm going to be buying the 165 call. So this is the 38 delta call. Okay, I'm going to buy it for 320, and we're going to analyze what happens to this trade. Okay, so we have the profit and loss, the risk profile right here. We're long a call, starts kicking in at 165. Okay, so now what I'm going to do is I'm going to simulate. This is where our trade is. This is our simulation engine. And what we're going to do is we're going to simulate a change in price, a change in volatility, and a change and 1 day passing. So basically, I'm going to see what will happen if the price of gold goes up by $10, and then next day, so 1 day passes, and the IV goes higher by 10 percentage points. And we're going to do the approximation. We're going to apply the formula, and we're going to see how close we are with this simulation so that you know whether your approximation is. And again, we're not considering all the different Greeks, the second order, third order, etc. So this is going to be an approximation, but it's good enough for you to get a sense of where you are or where you stand with your positions, especially if you want to take action. For example, in after hours, you could hedge your position by buying or selling stock. So this is a good use of the Delta-Gamma approximation. So we'll start. So I'm going to simulate that the next day there's going to be an increase in price by $10 so that we can easily do the calculation. So for Delta, we can see here we have 37.74 deltas in this position. So it's going higher by $10. So this is going to contribute $377.4. Okay. Now we're going to be looking at gamma, which is trading at 336. This is how much gamma we have in our position. Now remember that the contribution of gamma is 1/2 of the price change squared multiplied by gamma. So the change was $10, squared is $100, and then multiplied by gamma, which is 336, is going to be 336 divided by 2. So this is going to be 168, I believe. Yes, 168. So far we have 377.4 plus 168. Now 1 day is going to pass, so theta is 727. We need to subtract the 727. And then I'm going to simulate an increase in implied volatility of 10 percentage points. So Vega is going to be affected by $177 because we're going to multiply it by 10. Okay, So we have 377.4 plus 168 minus 727 plus 177. Okay, so right now we're showing that this position is losing 24, or actually, it just changed, $33.60. This is our current position. So we'll see what it changes by. Okay. So the amount that I'm coming up with our approximation is $715.13. So let's say 715. Okay. This is the profit that I'm expected to see if there is an increase of $10, an increase of 10 volatility percentage points, and the next day, so one day passing. Okay, so I'm going to simulate it here. Going to go $10 higher, and then I'm going to simulate the increase in volatility by 10 percentage points right here. Okay, so we have a profit now of 687.50, but we used to have a loss of 33.60, as I was saying. So the change itself is 687.5 minus a negative amount, so basically plus 33.60. So the actual simulation is giving me $721.10. So with our approximation, we have a profit that should be $715, and the actual simulation gave us $721. So we're close enough. So you can see that this approximation is a good way to get a sense for what your profit is going to be or what your losses are going to be when you don't have, for example, your platform available to you. So it's a good, and usually the changes in volatility are not that pronounced. So, and usually also the theta could be, especially if we're over, let's say 14 days to go or 7 days to go, then theta could be safely ignored because we're talking about, for example, in this case, $7, $10, etc. So you could use the delta approximation in a very accurate manner just by using the delta portion and the gamma portion. So most people, the whole reason why I wanted to do this lesson is because most people only consider delta. They say, okay, my portfolio has 35 deltas. That was a huge move, and now I'm going to be in a good position because if it went up by $10, I have 35 deltas. I'm going to be making 350 deltas. When they notice that they made $420, and they are perplexed, and in this case they'll be very happy because it was in their favor. But what happens if it's a loss and it's a greater loss than you anticipated because you're negative gamma, for example, when you sell options, and you don't consider the effect of gamma in any price move? Now, this comes into play when there is a violent, large in magnitude move. So basically, any move that's very small, you could consider gamma, or you could also you're going to see that it doesn't make a big difference. But if the move is big in magnitude, either up or down, you'll notice that you're going to have to take gamma into account. Otherwise, your numbers are going to be way off. And this is not because your platform had the wrong delta, but just because you haven't considered gamma. So basically, this whole lesson is so you guys take gamma into account when you do your calculations. Again, implied volatility, sometimes it's going to change a lot, sometimes it's not going to change a lot. And most of the time it's somewhat, it moves in a very, not in a violent way, unless there is a big event that's driving the implied volatility. So this is what this lesson was for, and I hope you guys got some information out of it. You got the formula when there's not a lot of change in implied volatility, just delta times the price change, and you just add the component for gamma, 1/2 of gamma multiplied by the square of the price change. I hope it was useful and hope to see you guys around next time. Goodbye.